Good morning everyone. Myself Yashvardhan and today we are here to present you some of the amazing concepts given by Mr. Peter Lynch in his book Beating the Street, which are applicable in Indian markets too. And some of the economic updates are coming after book. So let's start with the book. Mr. Peter Lynch, who managed the Fidelity Magellan Fund during the tenure of 1977 to 1990 and created a massive return of 2800%. What does it mean? It means that $1,000 invested in 1977 in Magellan Fund would be worth $28,000 till 1990. So, what were his key philosophies? The first key philosophy was invest in what you know. You should always invest in those companies which you can understand. Yet, this is being ignored by many individuals. And the second thing, stocks are not lottery tickets. There is a company behind the stock which is leading to its stock prices. So there is a fundamental thing behind that, right? So these were the main philosophies given by him. And to deeply understand what does these things mean, let's move further. Let us understand some of his key learnings. He always mention that you should invest in stock if you are looking for a long term perspective. Why is it? Because stocks have generated 11% return and fixed income securities generated only 5% return. Now if you have invested $10,000 in bond for 20 years, you would have only generated 14,000 income and a 10,000 principal repayment. But if you have invested same amount in stocks, 13,729 is the income generated and 46,610 is the principal repayment. You can see a massive outperformance by stocks over bonds. Now you should always have a diversified approach, not only stocks. You should always invest in funds. You can pick value fund, growth fund, capital appreciation fund and different type of fund. And he always mention that invest regularly. That is the first thing he always mentions. Now that the second and very important thing which Mr. Peter Lynch mentioned is that do your own research. That is scuttlebutt. Scuttlebutt is very crucial to understand whether the company have executed or is there any competitive advantage for any other company. That is the most important thing which he mentioned. With that you will have an edge. Why is it? Because you will meet companies, competitors, you will talk with them, you will have a early advantage and you will know whether there will be an industry shift. And now as you know the business, then you won't be checking stock prices because you know the business. That was the main key learning given by Mr. Peter Lynch. Now for deeply understanding many of the matrices and many understanding about businesses, my colleague Dhanesh will take over.
This is Dhanesh Fulfagar, and we are looking at the retail sector through Peter Lynch's eyes. Yes, he says that you should invest in what you know, but the journey for an investor doesn't just stop there. There is a certain checklist that he mentions one must go through to actually finding a true winner out of many companies. The first should be that the business should have a proven concept and with room to grow, which basically means that it should be able to run even one small store very profitably and then should be able to scale that store well to actually make it a multi-bagger idea. But in scaling, it also mentioned Peter Lynch also mentions that it shouldn't scale so fast that it can't keep up with its own progress. Same store sales growth is a very important indicator which kind of tracks whether your old stores are still gaining revenue growth while you set up new stores. This is one of the most important indicators in retail in the retail sector. While you are also keeping track of that, you should also be sure that if you find a cash machine which is throwing in a lot of money and has a proven business model, then the management for it should be frugal and should not diversify for the sake of growth. It is also important that you keep an eye on the PE ratio, which shouldn't be higher than the growth that the company is giving you. Now, once you have checked the profitability, the sales growth of the business, and its expansion plans, you must see whether the balance sheet shows you a similar picture or if it is completely different from the P&L. Now, the first thing that you can check is cash. If there is cash on the balance sheet, do check if this cash is coming to the balance sheet from the cash that is made from the operations, because that is a very healthy sign. Also, look at the inventory. If the inventory is piling up during a high seasonal quarter and the business is not ready to write down this inventory, and if it is a perishable good or something that is lost flavor in the market, then this is an upfront loss that the business is not willing to take. And they might be just effectively like they might be showing a higher profit, but they actually wouldn't be having that kind of a profit. So it's an important indicator to check. Now, you can also see goodwill on the balance sheet. If the expansion plans of the company are by inorganic means, that is by acquiring other companies, it would accumulate goodwill if the company is sold over its is bought over its market value. Now, this goodwill is something that you cannot actually tangibly measure. So a lot of goodwill on a balance sheet can sometimes signal danger. Also, check the debt to equity ratio in general, not for all companies, but in general, the debt to equity should be like a 2, and that would give you a very healthy sign. Other than that, I think you should know that not all debt is equal. Bank debt is a more stricter in terms of repayments as opposed to the other debt, which can be flexible, and you can the terms for it can vary.
Hello everybody. This slide talks about a very interesting idea from Peter Lynch. He says some of the best companies actually come from the worst or the most boring industry, because when an industry becomes trendy, too many companies enter the industry. This leads to price cutting, everyone taking it, and most players struggling to survive. Competition creates problem. But in a lousy industry, the good thing is nobody wants to enter, and over time the weaker players also exit. That's where the remaining companies actually start winning. But there are few qualities these surviving companies usually have in them. Number one, lowest cost operator. Southwest cost per mile was the lowest in the industry, giving them edge competition could not survive. Second, extreme frugality. These companies don't waste money on fancy and luxury offices. It sounds small, but it shows how serious they are about savings. Third, they keep the debt at very low level, which gives them comfort when the industry is not doing well. Fourth, they don't try to do everything. They choose one niche and become the best in that niche. Bandage is a good example for that. They dominated retread tires so well that competition did not even matter to them. Fifth, they treat their employees as their partners. This creates a motivated team, like Nucor promising no layoffs, which builds trust in their employees. And all this thing when put together shows us why these companies perform so well even in lousy industry. Because when competition fades, they grab the market share and dominate that industry. And when Wall Street ignored this industry, they only focus on execution, not trying to impress anyone. So great companies don't come from great industry. They come from companies that stay disciplined, keep their costs low, and outperform everyone else, especially in the lousy industry. So this slide is basically showing how cyclicals behave in a very opposite way compared to normal stocks. Normally when we see a low P, we think the stock is cheap, but with cyclicals, a low P usually means the company is at the peak of its earning. Everything looks perfect, demand is strong, analysts are excited, and that's actually when the risk is the highest, because the next phase is usually a downturn. And when the PE looks high, most people think it's expensive, but many times that high P is only because the company is going through a bad year, earnings are low, and no one wants your stock. That's usually the bottom of the cycle. With cyclicals, price moves first and earnings moves later. So you don't look at PE, you look at where you are in the cycle. This slide talks about how actually we judge a cyclical. The first thing is the balance sheet. A cyclical company must survive the bad year. If it's carrying too much debt, the company won't be around when the recovery phase comes in. So low debt and strong cash flow matter a lot. That's why Phelps Dodge, a copper company, survived. They were financially strong enough to handle a long down cycle. Next is understanding the main driver of the industry. Every cyclical has few variables in it. For copper, it's copper price. For auto, it's used car price and pent up demand. And when this start improving, you know the cycle is beginning to turn around even before the earning shows it. And then comes the timing. Here Peter Lynch gives a very important point. He says don't try to buy too early in the down cycles. Down cycle can last much longer than you expect. And if you buy too soon, you will sit on loss for a long time. Instead, wait for the upcycle to start a little, just enough to confirm that the things are actually improving. News might still look bad, but the indicators will start turning around. That's how you avoid traps and make money in cyclicals.
Hello everyone, I am Ayush and let's see what author has said about utility sector. He says that an investor who prefers regular income can prefer utility stocks over CDs. As in stocks, you have a possibility of dividend and capital appreciation, which is not the case with CDs. He further says that in this industry, he had best experiences with the companies who were in trouble. He mentions about a trouble cycle where the first stage is disaster hits. Now, this disaster could be because of anything. The second stage is crisis management, where company takes important decision to cut their spendings and dividends. The survival is a threat here. The third stage is financial stabilization. The company reduced their cost in such extent that now they are able to generate sufficient cash revenue to cover their cost. Survival is not a threat here. And the last stage is recovery. Recovery depends upon two things. First is the availability of capital, as capital is required for expansion. And second, the support of regulator, as regulator decides how much cost can be passed on to the consumers. And also, the government has a vested interest in the continuity of this enterprise, as they provide core infrastructure which is very important for the development. And case study of Siemens Energy has been shared. One of their nuclear plants became unusable and they had to write off an asset worth around $4 billion. The share price crashed like anything. But the best decision of the management was to convert that unusable nuclear plant into natural gas plant. And this decision became the turning point for the business. And soon they became the lowest cost producer of natural gas. Also, the other problem was that they had huge amount of debt, but the debt were of long term, so they got sufficient time to generate sustainable cash flow to service their debt. At last, the author says that the best strategy to invest in utility sector is to buy when the dividends are omitted and hold on to them until the dividends are restored. He says that this strategy has a terrific success ratio. The author here talks about privatization. Privatization is a process of government selling its stake to finance its deficit. And generally, government prices shares at a very discount so that their voter turn investor could enjoy this early price ride. And there are many other advantages also. For example, British water utilities was made debt-free before privatization. They had monopoly in their business, and also extra capital was infused for upgradation called green dowry. A system of partial payment was also made while transferring of shares. And all these advantages realized the author to make a rule, that is, whatever the queen is selling, just buy it. And another structure is master limited partnership. It's a partnership structure trading in the stock exchange. All the earnings in this structure are distributed to shareholders via high dividend or via return of capital, which is up to a certain extent is tax exempt. And this makes a complex paperwork. And also because of prior some tax related scams, these are generally ignored by the investors. And because of this ignorance, these are available at a cheap prices. Pre-1996, this structure was available for everyone, but post-1996, only real estate and natural resources company can operate through this structure.
Hello everyone, I am Shubham and now let us discuss about S&L businesses and how Peter Lynch viewed them and how he invested in them, what we call as banks and NBFCs. So Peter Lynch broadly categorized these businesses into three categories. The first are the bad guys. Now who are the bad guys? These are NBFCs that lend to dubious entities, right? Or they get involved in RPTs, i.e. lending to promoter linked entities. Now, one of the immediate examples that I can think of is DHFL that allegedly lent up to 29,000 crore worth of loans to 66 promoter owned entities. Next are the greedy guys. Now, they are not necessarily crooks or cons, but they get trapped in a positive business cycle, right? The builder loan cycle that happened in the 2018 during the Ireland FS crisis, right? So Piramal is one of the examples which had a very high exposure to builder loans. The third are the Jimmy Stewarts. Now they are truly contrarian in nature, right? They don't go with the cycle. Their books are really granular. They have exposure into more consumer loans, personal loans like Bajaj Finance, HDFC Bank. They have been able to maintain their NPAs. They have a very loyal deposit base as well, which is their sources of funds, which are low cost in nature, right? Now, Peter Lynch has certain parameters that he uses to judge S&Ls, right, or NBFCs. First is the asset or equity ratio, which we also call as financial leverage. Now, why is this important? See, you can show any amount of loan book growth in the present, but the issues pop up in the future, right? So you can hide any amount of cockroaches you can, and you can show a decent loan book growth, but what happens during recoveries? Next, high risk assets. Why are these important? Because if you have a very, again, as I said, these builder loans are chunky in nature, yeah, right? You are lending to a single entity. So Peter Lynch says that about 5 to 10% of the overall assets should be to only these type of loans, right, which are much chunkier in nature, right, builder loans or developer loans. Next are the 90-day non-performing assets, right? So these are loans that have gone bad. So they have crossed the 90-day mark for the recovery and now they have gone bad, and this should be limited to 2% of the overall assets. In case of banks, we should look at the book value and not the earnings. Why? Look, earnings get hit due to temporary reasons, right? A bank or an NBFC can decide to be conservative. For example, Arman Finance, for example, can decide to be conservative and take the pain upfront, right? So in a positive cycle, it is provisioning for future losses, right? Because it knows that if it is in such a high growth cycle, losses may come in the future, right? So we have to also check the book value because it is much more linear in nature, and the book value, overall book value growth as well. Thus, price to book ratio is a better ratio to analyze than the price to earning in case of banks. Now, there are specifically three case studies that I picked from the book. Why? Because these were the most, these seem like the most relevant to me at least. The Germantown savings, for example, are the top quality banks, right? That Peter Lynch was mentioning about. Very low NPAs, very healthy equity to the leverage ratio is low, a low PE ratio, which again shouldn't be seen in banks. But okay, Sovereign Bancorp has a separate strategy, right? It used to go and acquire local regional banks. So back then, what happened is that banks used to have a local deposit basis, right? And they could lend to anyone, but they could only raise deposits from their own local areas, right? So when these used to go bust, Bancorp used to go and acquire them. And finally is the First Essex. Now Peter Lynch sometimes got involved in turnarounds as well, and yeah, so you can see how again it's the NPAs is so high, but still Peter Lynch bet on the quality of the assets that were there, and he went and saw that the builder, even if they were builder loans, they were probably into they were probably into assets which could be recovered a bit easier. Now, finally, this is the Indian example that I was talking about. We can see how Island FS, DHFL, Piramal all fell trapped to the builder loan issue, right? And all of them fell trapped to the asset liability mismatches as well. So, for example, Island FS used to use commercial papers, right, for as a source of funds, which are short term in nature, but lent loans up to 8 to 10 years, right? And imagine a 90% exposure to infrastructure loans, which are longer term in nature. What kind of asset liability mismatch it can create? DHFL opened up shell companies to reroute these loans, right? And it also used evergreening, right? Evergreening is using others' loans to repay someone else's loans, right? So these are some of the things that happen in banks. So now let's get into the economic indicators part and the current affairs part. The reason we are starting with economic indicators is because the story behind those we'll learn it in the later slides, right? But I just wanted to focus on the July-August part, right? You'll see a large spike in the GST e-way bills, IIP infrastructure, IIP manufacturing, PMI exports. Now there are multiple reasons for that, but one of the major reasons is because of the export front loading that happened during that time. So as you all know, August 25, 2025 was the deadline. Post which India will face a 50% tariff regime, right? And that's why we have seen a large moderation, but that's not the only reason. The second reason is the GST implementation. So you have to understand the concept of input tax credits. What happened during this time was that government allowed all the inventory. So for example, imagine the semi-finished goods that was there in the factory. The companies tried to push it to the retailers as soon as possible, right? So which was applicable under the old GST regime, and also to avail the input tax credits scheme as well, which was invented during the GST criteria. So because of which the GST e-way bill spike and then a sudden moderation to 8.2% is visible on the charts. However, these numbers have slowly been better in the coming quarters because of the festive season coming back. Finally, I also want to show you the recovery of the credit to industry growth, which is a very healthy sign after a very dull phase. You can see that from June to September, there has been a very dull phase, post which now micro and small, medium and large caps. Now, the large caps always have a low credit growth because they don't need a lot of credit growth, right? They have healthy balance sheet, they have a lot of cash on the balance sheet. And the final thing that I want to show you is the personal loans, right? We can see that the loans against gold jewelry have grown at a very, very healthy pace, simply because as the price of the gold value increases, even at a constant LTV, the loan amount that a person gets increases, right? And finally, I wanted to take a look at the Obicus data, which is hinting some slowdown, right? A pile up of the final finished goods inventory with the manufacturer. So these are some of the signs. These are mixed signs. But all in all, there has been an uptick due to the GST, but let's see whether it's a one-off or whether it continues further. Now let us discuss the state of monetary policy in our country. So RBI, after a long 23-month pause of keeping repo rates at 6.5%, finally decided that something was going wrong in the month of July August 2024. But why did it go for such a long pause in the first place? One, stubborn inflation. For almost all of FY 2024, due to food and fuel inflation, the reported headline inflation was almost in the range of 5.5% to 6%, which was uncomfortable for RBI, and it said that it affected the consumer directly. Second, flows. If RBI cut interest rates too soon, the interest rate differential between US and India would have caused outflows of FIIs. Third, the peaking credit to deposit ratios. See, the credit to deposit ratio almost had reached 77 to 78% compared to which was even higher than the 2018 and 19 levels, because of which it felt a discomfort. But finally, in the month of January 2025, RBI went for a cumulatively, it went for a 125 basis points cut. So the repo rate fell from almost 6.5% to now 5.25%. It has also injected, so both quantitative and qualitative easing has to happen, right? So because of this, RBI has also purchased OMO bonds from banks for about 1 lakh crores, and it has infused even more liquidity into the system by CRR cuts as well. And it has also done USD INR swaps for more rupee liquidity infusion into the system, right? Finally, the bond yields have responded positively to this, and RBI calls this the Goldilocks period, where the GDP growth is in healthy single digit growth and inflation is at a record low. So now let's discuss what's happening with the Indian markets and in their respective sectors, indices. So if you look at the sectoral performance breakdown, banks and autos have been the clear winners, right? And all the proxies related to autos as well, auto ancillary companies. The reason for this is twofold. One, the recent GST cuts that have happened, and two, the recent RBI rate cuts that have taken place, right? But if you look at IT, even if the percentage is much lower, so this basically this ratio is showing the percentage of stocks near the 52-week highs, right, in that sector. So even IT is coming back in strength. Why is that? Because in the last quarter, there have been a lot of earnings beats by the large entities like TCS, Infosys, LTI Mindtree. Why? Because majorly their large clients are again upping their spendings in their, at least in the AI domains as well. That's one. Second is that if we look at the market bet is a great indicator to determine the cheapness of a market. Now, obviously, stocks near 52-week highs. If you look at the numbers, when they're close to 15 to 20%, that's when we can say that the market is relatively cheaper and a good place to buy in a lump sum way. So that happened recently in March 2025. We can see in some extreme cases where in June 2022 or March 2020, like COVID, October 2018, these can drop to 10% as well, and the market becomes extremely cheap during that time. Right? There is also an indicator called the Nifty 200-day moving average, the percentage of stocks that are above the 200-day moving average. That can also be used to determine the cheapness of the markets, whether the market is weak or in strength. The third thing that we can look at is the Nifty PE ratio. The Nifty PE ratio is at 22.8 times, but the quality of the balance sheets of India Inc. has been very strong. So I think this premium is a bit justified. Obviously, it's much higher than the historical average of 16.2%. So if the earnings growth continue at a healthy pace, then this valuation seems justified. Last is a long-term performance of 3-year rolling performance, which we can use to compare and uh, use to rotate our money between several indices.
All right, now moving on to tariffs. Now, Donald Trump imposed tariffs so that he could bring back manufacturing and reduce America's fiscal deficit. While $215.2 billion have been earned in tariffs by September, Donald Trump has also had to reduce tariffs on 200 plus food items, highlighting the costs borne by the consumers. India today faces about 50% of the tariffs, out of which 25% is because America believes that India is fueling the Russia Ukraine war by buying Russian oil. Now, while Trump has made many trade frameworks and trade deals with a lot of other countries, India's trade deal still seems elusive. While there is a delegation in India today, and there is some positive chatter about it, there is no trade deal yet. As a relief measure for exporters, India has announced a 26,000 crore export mission, delayed moratorium periods, and extended credit periods. Now, moving on to the next topic, which is AI. Now, AI, contrary to what most people believe, isn't just something that is, a decade old. The first time the term AI was coined was in the 1950s, and from then, AI has grown leaps and bounds. I mean, the way it looks at, processes, and gives an output of the data that we feed into it, it was once unthinkable. I mean, think of it. Uh, a model that was once tested on if it can recognize images, can today actually predict floods, or it has even accelerated drug discovery in the sense that AI has been able to analyze 20 million proteins, something that humans would take over 1,000 or even 1,000,000 years to do. It is this speed at which AI is growing, and it is this speed because of which, which has brought the Indian IT industry to a standstill. Today, the Indian IT industry is worth $250 billion in exports, has 5.4 million employees who take a salary of about $1.120 billion. Now, the fear is that in the future, the IT industry will not need so many employees anymore. If it was using 100, it would need 40 employees, which actually had a more affinity of using AI, and that would be enough for them. Today, India has produces or creates almost 1.5 million engineers per year. If the IT industry stops requiring them, where would they go? And also, if the IT industry comes to a standstill or the revenues come to a standstill, it would have a massive impact on India's consumption and also on the GDP. But the story is not as gloomy as it seems. While the employees might lose their jobs, the employees that will keep their jobs will actually be very high paying, and the IT companies will actually survive, whereas they will have newer jobs to do and newer contracts to fulfill in terms of the output that AI would require. Or there would be extremely new possibilities that Gen AI will create, which we are not able to think of today. Now, but even there is a catch, which is the valuations at which AI companies trade today. And to speak about that, I would like to call upon my friend Yash.
Let's understand what's happening in AI. Over the last 5 years, top tech firms capex stood at $1 trillion, and oil and gas, which accounts for nearly 50% world's consumption, that is tangible, which accounts for $800 billion. So the AI's capital allocation is massive, which accounts for 1.2% of US GDP. Now it beats the telecom bubble and the dot com bubble, yet the economic gains are still not defined. Now the depreciation. Large tech companies stretches the server's life 5 to 6 years, and although Nvidia GPUs become obsolete economically very faster, so longer the life inflates the profit for the entire AI and help them justify the capex cycle. That is how all the things are going on, and the demand is still organic or unorganic, it's still not defined. Let's have a look at quarter 2 FY26 GDP data. 8.2% is the GDP growth for FY26, which was 5.6% in FY25. So we can see a decent growth, which is driven by the private consumption that grew at 7.9%, which accounts for 57% of GDP. Even the private capex was muted. On the other hand, if we see the government expenditure, which was 7.4% in quarter 1, but a slowdown in government capex in quarter 2 stood at 2.7%. Now, if we see at the sectoral breakdown, then we can see manufacturing grew at 9.2%, services grew at 9.2%, and public administrative also grew at 8.7%. Agriculture was nearly stable with 3.5%, and the festive early stocking, which was driven by GST rate cut effect on 22 September, have shown a decent export growth, that is nearly 8.8%. So that is how the quarter 2 GDP number looks like.
Hello everyone. Today we are going to talk about production linked incentive schemes PLI. PLI offers 4 to 18% of incentives to companies to manufacture in India. The goal is to reduce imports and make India globally competitive. In order to achieve this, the government has already rolled out PLIs in 15 plus major sectors. The major allocations being 26,000 crores for autos, 18,000 crores for batteries, and 43,000 crores for specialty steel. India has already reaped some of its benefit. India now exports 23 billion worth dollars of smartphone in FY25, which was zero in FY18. India also produces 20% of all global iPhone, and along with it, the specialty steel production has risen by 14 million ton. But there are some few challenges in PLI that companies face. Companies face heavy localization rules, heavy documentation rules, and the fact that majority of the high value products like battery and steel are imported.
This alone was the reason why only 1.4 gigawatt hours of battery was produced when the target was 50 gigawatt hours. But the way forward we should look at PLI is that India should focus more on building component ecosystem, stronger supply clusters, paying the companies faster and easing the rules for them, and working with the top 50 brands of the world so that we can scale sectors like electronics, EVs, and aerospace. Gold imports jumped to $14.7 billion in October, which was $4.9 billion last year. This led to a record trade deficit of $41.68 billion. This also shows how quickly gold demand pressures the external trade balance. At the same time, gold loan market is going up very fast, 115% YoY growth, which led to industry AUM of 3.2 trillion rupees. NBFCs are planning to open 3,000 new branches, and at the same time, gold ETF AUM has become 1 trillion rupees. So overall, gold has become the major growth driver of both credit growth and the financial liquidity.
Hello everyone. Imagine your entire house runs on a single giant power socket. It's convenient until the day it sparks. And that's the case with the entire world. China is powering the global manufacturing with 33% contribution. But now the global manufacturers want to shift their production out of China because of geopolitical tensions, shrinking workforce in China, strategic de-risking, and also because China was using its position as a weapon. Example, NdFeB magnet, which is the world's strongest magnet today, used in EVs and defense industries. China controlled its 90% supply chain. Although India has recently set up a plant in Pune with around 15,000 tons capacity to produce NdPr, but it's a raw material. India still lacks in capacity to produce finished product that is NdFeB magnet, and China is not letting anyone else become a major player in this sector. For example, recently it acquired an Australian company Peak, which was trying to mine rare earth in Tanzania for many years. The Indian government's recent scheme, with an outlay of 7,200 crore for end-to-end manufacturing of rare earth magnet in India, with an annual capacity of 6,000 metric tons, is a major step in this direction.